You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 1:30 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by Quikstrike, options pricing and analysis software. Quikstrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. Quikstrike has you covered with market data reports ranging from open interest to the term structure of volatility. Quikstrike is the perfect addition to your trading toolkit. Learn more about Quikstrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at Quikstrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That funky tune, some may call it funkalicious, it means it's time for TWIFO, This Week in Futures Options. If you were in the studio here, listeners, you could see us all bopping to that funky tune. It's a great way to close out our broadcast week here on the old network with the funkiest, the funnest, indeed the most topical, or at least one of them shows this week at least here on the old network. Yes, TWIFO, the program where we break down all the hot action in the world of futures options. That means crude, gold, lean hogs, whatever's floating your boat and catching some eyes in the marketplace this week. We're going to break it down. I got a feeling, just an inkling, we're going to talk about crude this week, but you never know. We'll get to it in a second. My name is, of course, Mark Longo from theoptionsinsider.com, as well as, of course, from the ever fun, at least we hope so, Options Insider Radio Network. And, of course, you can always find all the archives of this program and everything else, all the other 14 programs on the network, the mothership, the flagship, theoptionsinsider.com. You also got breaking news from the options market there. A lot of great text content up there, too, if you want to expand your horizons beyond just radio. You actually want to read a little bit, we got you covered. We also have an email newsletter you can sign up for. Goes out to quite a few people every week as well. You can catch it all there. And, of course, if you just want to mainline the radio, if you're hardcore for the radio, we got you. got you covered over there. iTunes, TuneIn, Stitcher. Also got our own mobile app available for all the major platforms. So however you want to get it, you can get it. We got you covered. We also coming at you live every Friday, 1:30 p.m. Central, 2:30 p.m. Eastern via Mixlr, MIXLR. So follow us on social media. We tweet out the link all the time. We're just ad options on most of the major platforms. And you can grab that link and bookmark it. Follow us on Mixlr if you're so inclined and be notified the instant we go live with all of our shows throughout the week. It's a fun time. You can see how the sausage is made, even ask some questions maybe behind the scenes instead of waiting for the nice edited, fun podcast version, which we're also happy to have you guys downloading out there too. However you listen, however you get the show, we don't care as long as you send us some questions, some comments. We do love to hear from you guys at the end of the day. And joining me on the old program today, he's fired up. He's been off for a couple of weeks. Of course, markets were closed last week, so he's rearing and ready to go. Mr. Nick Howard, the founder and CEO of Quikstrike. Mr. Nick, welcome back to the TWIFO program, sir.
Hey, good to be here, sitting in the home office, ready to go.
All right, you are ready to go, sir. So without further ado, let's get right into it. What do you think? Should we start off in like fluid milk this week? You know, maybe lean hogs? What product do you think is really getting everybody's attention this week?
I'm sure it's the fluid milk. So we could probably leave that as like the highlight and start off with crude oil.
That's the teaser. We're going to tease them with some fluid milk. So stay for this full show, and we'll hit you with some fluid milk on the way out. There we go. Who wouldn't stay for a tease like that? All right, yeah, of course. We're going to kick things off in crude in the big mothership WTI out there right now. It was, again, an interesting and active week. A lot of you guys have been hitting us up saying, wither the crude vol, where you ask for it. You got it this week. A nice little pop out there in crude as a result of a lot of the late week sell-off action out there in the big futures. Most of the futures down about 4 handles, pretty much across the board. So shy, at least a lot of them shy right around or close to breaking through that mythical, magical 50 handle, which everyone and their mother is watching. Once we break through that, we start seeing that vol inexorably creep up. That's exactly what we saw this week. Most of the futures off about 7% to end the week. That meant we got upside, a little green on the vol screen. It's been some time, Nick, since we saw that. It was probably back about a month ago or so in that last big kind of really near-term sell-off we saw out there in crude. Of course, that didn't last. We saw that sell-off reverse itself, get back over 50. We saw that vol go away. The question everyone's going to have now is whether this vol can even stay. In fact, we usually get to them in the questions. Here's one here from the feedback. We'll just get to it now because it's so pertinent to what we're saying. This comes from, I like this handle, the Nubs. You got a handle like that, we'll probably answer your question, even if it's terrible, just because it's silly. All right, is this the move we needed to pop WTI vol, or do we need more? Nick, I'll let you weigh in on it as well in a little bit, but it seems like, this is a good start. This is kind of like what we had last time where we sold off to a little bit lower in these levels, I believe, but it was nice. It's that breaking through the 50. It really seems to shock everyone awake. All of a sudden, everyone sits up and says, hey, what's going on out there in crude land? And then all of a sudden people start looking and the vol starts creeping up. People who've been granted buying vol out in crude has been a pretty rough trade for the better part of the last year. So some people have been beaten down. So they may be a little bit more reticent to pull the trigger. They need a little bit more protracted moves. That's kind of what we're going to need right now. When Nick gets up in a little bit to talk about the quikskey, we can talk about how that's breaking down as well. Obviously the skew going to dictate how a lot of this volatility shapes up. Skew has always been bid to the downside in crude for the better part of the last year. We have seen some near-term spikes in call skew, so you can get a little love that way as well. But the long-term bid is still out in the puts in crude land. And so as we can keep sliding down that curve, we will see vol continue to move up. So short answer, this is nice to pop it. So I guess you're right there. But do we need more? Yeah, I think we need more. We need some follow-through on this sell-off if you want to keep these vol levels. Otherwise, we're going to go right back up, right back up in the crude, right back down from a vol perspective. I don't care how you track it. You look at straight-up implied. You look at something like the OIV, which is the VIX of WTI, which popped above 30 again this week. We haven't seen that in a while. So that was a good sign, maybe a little bit of life out there. All you guys out looking to harvest some premium, maybe this will attract some of those guys back into this fence who've been maybe lured elsewhere by other pockets of vol out there. And of course, volume this week also pretty strong out there. Open interest up about 10% this week, which is a hefty pop. Usually we see WTI doing like 4.5% in a week, so roughly double what they typically are doing out there. So a sign that things were indeed rocking and rolling. If you came to me right now and said, Mark, where was all this activity centered? Where was the lion's share of the activity? If you guessed the front month, you would be the winner on our game show, which doesn't exist. Unfortunately, no prizes for you. About 66, about 2/3 of the volume going up out there in that front month contract out there, which is the June contract right now. So yeah, a lot of paper going up out there. And if you were going to say to me, on the top of this, on the surface, we have one of our first sell-offs in a while in crude. Where is the activity centered? I probably would not have guessed what we saw this week. So read into these tea leaves what you will. If you had a guess today, you see a sell-off, we finally break through, we're dancing with the 50 handle. You might think front month 50 puts, maybe 45 puts would be leading the dance. And no, you would be wrong. They were active, certainly, but it was actually the double calls, the 55 calls, that were lighting it up for a lot of opening paper, too. That's the cool thing about Quikstrike. Again, you guys want to play along with the show itself. I always forget to tell you, top of the show, cmegroup.com/TWIFO, TWIFO. You guys can generate the reports for yourselves. I think Nick and his team, they're going to tease a fun little update to those coming soon. We'll get to that at the end of the show. Another tease for you in addition to that juicy milk tease. So yeah, you can play along with these reports. These are active all week long. So even when we're not doing a show, even when Wednesday, you can come in here and pull it up. And obviously they'll be weighted for whatever the time period you're looking at it is. But still, these reports are active all week long. So you can go check them out whenever you want. cmegroup.com/TWIFO. Yeah, the double calls, 55 calls in June, lighting it up. Number one with a bullet this week. 55,000 contracts, a good chunk of that opening, including 30,000 of that 55,000 coming on Wednesday, with about 13,000 of that actually opening. So there is obviously some closing action there too, but still a lot of paper going up this past week. 30,000 total. Actually, I'm sorry, the total was 87,000. The open interest is 55,000. The total, number one with a bullet, even more than I thought. 87,000, 30,000 on Wednesday, almost the same number, about 29,000 and change going up on Thursday. So 60,000 coming in those 2 days alone. So just huge paper out there for these double calls, which is, again, probably surprising to a lot of people. The thing a lot of people probably thought would be winning the 50 put, taking the number 2 spot, 71,000 and change, including a good chunk of those coming today. Nearly 30,000 of that 71,000. So almost half coming in today's paper, about 29,000 going up today. So pretty active day out here for the 50 puts. Again, not surprising. We're flirting with that handle right now. So seeing some of that love coming out there is kind of interesting. So those two kind of the dominant forces out here in WTI this week. Of those two, you add them together, you get about 160,000 contracts, which is more than most other products do in an entire week just in those two contracts. So pretty active out here. Then it falls off a bit to the number 3 spot. We get to just a little slightly less optimistic 54 calls. 36,000 contracts and change, including a good chunk, about 12,000 coming on Wednesday. So Wednesday, a heavy call day out there in WTI. I'll let Nick get into the skew stuff and things in a little bit. It also is worthy of note, again, if you're playing around with those reports on the Quikstrike, you want to see maybe how some of the longer term action is fared, go up to the expirations tab, and then you'll see all the front year are going to be selected. Add in a couple of extra months. I usually like to add in at least the June and the Dece of 2018 to get a little bit of a longer term picture out there, but you can pick your poison depending on the product. If you do that, you'll see a little bit longer term paper lighting it up out there as well, as including the Dece 2018 65 calls, lighting it up this week to the tune of about 4,600 total, including a good chunk, about 2,500 come in on Friday, about 1,500 come in today, so 4,000 of that 4,600 coming in the last 2 days. So a little bit of longer term call up, maybe hedging something, or maybe saying they're not buying into what people are saying about this U.S. production really leaning on that. If you're wondering why crude was down, that was pretty much what it was. They're seeing renewed concerns about increasing U.S. production levels and also increasing U.S. inventories. Very high still. There's still a bit of a glut out there for crude. So we have these kind of two dynamic forces. We have the Saudis and OPEC trying to squeeze crude back up. We got this high supply. We got growing U.S. production, tamping that growth down a little bit. So you got these two forces pushing and pulling. Seems like the latter was in the driver's seat this week. We also did see some longer term. These are June of next year, so about a little over a year away. 50 puts also lighting it up this week to the tune of about nearly 5,000 going up out there, about 4,700 and change, including about 3,000 going up on Wednesday. So some pretty active stuff across the board out here in WTI this week, Mr. Nick. What are your thoughts out here, and what's catching your eye out there from a vol perspective, and break down some quikskey for us as well, sir?
Sure, yeah. A couple other mentions that we probably want to throw out there is if we look at the overall volume for the week, you'll notice that the calls were more prominently traded than the puts. So you have the total put call ratio is about 8.83. So that means there was a little bit of a lead going to the calls. And one thing of note on those 55 calls that you mentioned is a lot of that activity came on the EIA day, which was Wednesday, and it looked like people were taking an opportunity to get calls at a cheaper price after we had that initial break. And I shot out the vol for yesterday and today as well out on Twitter, so you could take a look and see how it reacted today. But that was one of the things I noticed when I saw that number go up quite a bit on Wednesday was we got that little bit of a break, and then there was some activity on the upside. So if you go out there and look on Wednesday, you're going to notice that on that volume chart I sent out as well, you're going to notice that a lot of activity took place on that initial break, and I think it's people trying to get in thinking that the overall, getting to the point with the nubs, what he was asking for or she was asking for, overall, I think the bias is still on the upside, even though we had some of this, downside pressure from the report and the inventories and that type of thing. But you still saw a lot more people come in there and look for calls, because if you go down the list and look at the top 10 trades, you're going to see there's top 10 in calls and the puts on that report we sent out, but you're going to see 55s traded, 54s traded, 51s, which makes sense because we went through that strike, but the 57s traded quite a bit, 28,000, 53s, 56s, even the 58s and 60s. So I think what you saw, and a lot of that was all those upside calls for them. All the upside calls for the most part were openings. So I think what you're seeing is that people saying, okay, we made a break, but I'm going to still guess that we're going to move a little bit more toward the upside. So that was kind of the first thing that really caught my eye. And to sort of blend in the question from the nubs with what we've seen here, we saw a little bit of a break on Wednesday, right? We saw like probably what it was. I think, let's see what I got here. I thought it was like, we saw about a $2 break, maybe a little bit more. So about a 4% break on Wednesday, and you didn't. And I took a look then, and you didn't really see volatility popping all that much. You saw a little bit of an increase, but not a great deal. You saw a push up, but not a great deal. And we've talked about it in the show before. You kind of get a 2%, then you get we were saying that 2% doesn't really do much. 4% starts to kick in, but you got to get that continued move on the downside. So we saw a little bit more activity as we continue to go down. Now, is it going to continue? It was pretty low, so we saw a pretty decent jump out there. But unless we continue to move lower, nubs, I'm not sure that we're going to see this vol increase. We were down pretty low, so it didn't take much of an event to push it up higher. But again, if we come in on Monday and we're trading 48, I think you're going to see vol up quite a bit. But if we come in on Monday and trading 51.5, I don't necessarily know that that's going to be the case. So a lot of this activity came today. A lot of this other downside came today, and that pushed the volatility up quite a bit. So actually, not a tremendous amount today, but it did push it up still a little bit. So we got some increases, but those were more, I think, on the July, August, and the September today, as opposed to the front contract. What else is happening? What else is catching my eye out there? So if we start to take a look at the quick skew numbers or just the skew numbers in general, we're seeing that there's a move towards the positive, meaning the calls are a little bit better bid than they have been starting at the beginning of this week. And if we're looking at the quick skew numbers, which you can see out there, you're going to notice that where that positive change came from, it's going to come from the fact that the puts got a little bit less expensive and the calls got a little less cheap. So we're definitely seeing a little bit of a shift from a vol curve standpoint. And it kind of makes sense based on what we've seen with the volume that we have out there in the upside, right? So since there was a bias for the calls, we saw a break of people coming back into the market to try to get some of that upside that was maybe a little bit cheap with the intent of the expectation that the market's going to move back up. So change in skew, less cheap calls, less expensive puts. And I think we're seeing that across the board in the 2017 contracts as well as in the June 18 and December 18 contracts. So, or for the most part, probably all of those, but the December contract had a little bit of a difference in the call. But that's what we're seeing there. So, and that's kind of really being reflected in the volume numbers as well. And you can go down there and look at the put call ratios for each of the months as well, and you see that calls were generally dominating in the more liquid contracts. As far as anything else goes from a volatility standpoint, I think we answered the nubs question. If we come in lower, I think you're going to, we're still kind of range bound, right? A few weeks ago, we were trading less than 49 and 49 and a half, which is where we are right now. And the vol was still, kind of beat down a little bit. We rallied up, we saw things come off again. We're coming back down. So we're still sort of range bound. And, as much as 50 is a marker for where the bottom support is, because of where we were in the prior weeks, we've established sort of a lower bound as well in terms of where people are going to be comfortable with this market trading. And if we go look at the open interest out here, we really, 48 is our next level. The 50 is there. I don't think it is, even though it's the highest open interest from a put standpoint, I don't think that it's scaring people as much as it used to. And I think you're going to see, 48 is the next marker here, then 47, and the big one is 45. So if we start to touch down on 48, go through that again, I think you're going to see the ball stay firm, maybe get a little bit further bid if there was some, and then, our next kind of level is 45. But I don't necessarily know that the news is going to push us that low at this point. So I think, Mark, anything else there? I think that's.
I think we hit on all of it. I'm just trying to debate. Yeah. I was trying to ask the listeners a little bit too, but it's sometimes hard to get things. Some of the other things going on behind the scenes here on the show. Get these polls out in a timely manner. What are you feeling, Mr. Nick? For we want to probably at least squeeze one more on here before we get to some of their questions as well. What are you feeling? You feeling more gold, or we're getting some interest? Seems like as well on the E-mini again. That skew seems to be ticking up. So what's floating your boat? I'll let you make the final call.
Yeah, I was looking at both of them before the show. Let me take a look real quick here again at the gold. Let's take a look at gold. I think that's probably worth it. There's some things that we can cover there as well. So I just
of course you would pick gold because I had the E-mini open on my screen. So let me go back to gold. 1 second.
You got to create some shortcuts.
Let me vamp. Let me vamp a bit here. But of course, the same thing, listeners, always, and extend the expirations. So you can kind of see the full, particularly with the metals. We see a lot of longer-term paper out here in the metals. You too can play along. CMEGroup.com/TWIFO. Go to that product drop-down, select the metals, then select the gold, then play with the expiration just like I did. And you can have the nice view that we're seeing right now. Kicking things off right here, May, front month, leading the charge out here in gold. Again, as you mentioned, gold, a little bit of a mover this week as well, selling off about 5 handles or so. I guess depends where you're looking, about 2.5%, depending on where you're looking out there. In the term structure, also seeing gold vol, which has been higher, kind of coming off a little bit this week, which is kind of interesting. Usually some sell-offs, you see a little bit of a thing. But gold, again, has been kind of interesting, kind of been in rally-ho mode of late, flirting with that 1,300 level again, 1285, 1290, settling around in that region this week. We were talking on our last show. They were saying how the gold skew out there, depending on where you're looking, I believe they termed it. It looks like a double diamond on a ski slope. So pretty crazy stuff out there from a severity of slope perspective. I'll let Nick get into that a little bit when he gets into the quikskey a bit as well. In terms of number one with the bullet out here for all things shiny stuff, all things gold, it was maybe a little bit higher than you're probably thinking out here as well. So maybe a couple of surprise number ones for you in crude and in gold, with about 10,000 and change of the 1320 calls. So fairly out of the money calls lighting it up right now, including about 9,000 going up today. So we obviously don't have a breakdown on whether those were opening or not. The rest of the week paper slightly opening on the day, but we'll see how today's numbers shape up. But that was the lion's share of that trade, putting it over the top. Maybe someone thinking maybe a gold bug coming in. We know the gold bugs are out there. Maybe a gold bug coming in saying, you know what, any sell-off is a good chance to buy me some gold and some gold upside, taking advantage of that today, or maybe perhaps closing out a little more optimistic position that didn't work his way. We'll have to wait till tomorrow to know for sure there. Number two, also on the upside, this time 1310s, a little bit closer to home, a little bit closer to the fire there. These about 8,000 contracts and change, including a good chunk, about 6,200, coming on Thursday, about roughly half of which were opening out there. And then we drop off a little bit again, not much though, to a little bit closer, a little bit more at the money call, the 1290. So a nice little call strip out here in gold this week, 1320, 1310, and 1290. The number one, number two, and number three on the active list out here for gold options. About nearly 8,000 of those 1290s coming out here as well, including big chunks, 2,200 and change on Wednesday, and about 2,300 today coming up here in this name. So about nearly 5,000 of that 7,900, almost 8,000 coming in those two sessions. If you look a little bit farther off as well, there really wasn't a lot. Sometimes gold usually is the one that exhibits a little bit of longer term paper here or there. But just taking a quick peek out to some of the longer terms, about as far out we saw any real meaningful action this week was in the DEES of this year, DEES 2017, so not even into 2018. We saw the 1400s, which is kind of interesting, about 1,300 of those going up this week. Important to note, though, not some of those closing, good chunk of those actually appear to be closing, so not a lot of opening love out there for some longer term gold action. Net on the week, about just slightly more than half of the overall paper coming in this front month May contract, which is going away in about 4 days, so it's pretty much a weekly at this point. So still leading the volume charts, though, in terms of where the action is, and overall open interest about on par, up about 3.5% this week. So an interesting week for gold. Mr. Nick, I'll let you dive into all things quikskey, as well as what else was catching your eye out there in gold land this week.
Yeah, just to make mention that as this May contract comes toward expiration, we start to see the June contract is the highest open interest out there. So that's where we're going to see a majority of what's going on from a change in OI standpoint. Although we did see a significant number in the May contract, but obviously that's this week. That's trading down towards expiration. I think the reason I wanted to cover that a little bit was just to again talk about the put call ratios and also what we're seeing with the quikskey numbers again. And then I'm going to address a couple other things that we've been talking about over the last 2 or 3 weeks, so you have yourself ready for when it is actually going to be out there. But again, market didn't do much in terms of movement this week. It was down, right, and it had a rally of like $45 or $50 over the last 3 weeks. So, but we're still seeing a majority of the trade volume being call biased, right? And to support some of that, at least in the most, and again, I'm going to stick to the most open or the most active contract, right? So we're really going to look at the June contract, and we can even go look out into the December contract, where we're going to see something pretty significant happening out there, and I'm going to have to take a look at that in a little bit more detail. But the June contract, we see the calls and the puts, calls got a little bit richer, and the puts got a little bit cheaper in the June. So still, even though we're kind of trending sideways, there was still, and we're seeing that in the put call ratio as well from the volume standpoint, we're still seeing a bias and a bigger push on that on that vol curve for a push up for the calls, a push down for the puts. So again, it's getting a little bit more tilt in there, right? So the teeter-totter is up almost at the, if we take a look at that, how high has that been? Are we near our highs? We're not necessarily near where our highs are, but we are as wide as we've been in the last 2 or 3 months. From a call richness standpoint, the puts are as cheap as they've been over the last year. So for the June contract itself, so something to consider. That's when you want to start watching, when you start looking at the historicals and see where they're matching up. You want to start watching those and seeing what's happening there. And if I could take a look at this quick vol here, I might be able to do this. We have a new feature. And we'll do a test today. What do you say, Mark? We're going to do a test today with this new feature.
I'm up for it. Hit me.
All right, let's see what I got. Let me see what I can see if it shows up here. Is it here yet? Give me some love. It's not in that, is it? So it's not there. Is it? Let me see. Oh, not quite. Well, what we can do, and I have to do it
The magic of live demos, sir.
The magic of live demos, yeah, because it's brand new. What we're doing now is we added a tweet button to all of our views. So now I'm able to just push it out right away, and the viewers will be able to do the same. So if they're in Quikstrike, they'll be able to tweet a chart or tweet a table, and it'll be right out there and ready and available. But yeah, well, I think the thing to keep an eye on here in the June contract here for the gold is take a look at that quikskey number, match it against the week prior. I think we're going to add that week back in there for you, so it's easier for you to see how it's changed over the week. But during the show, all those things will show up starting next week. We started to talk about it was going to maybe be available this week. A couple of us were out of town, so we didn't get a chance to finalize what it is. But all the links will be active starting next week. So if you're really going to start listening, or you want to tell people about the show and really be able to dive in during the broadcast, next week will be the week where everything we're talking about, those pictures we're tweeting out, those are all going to be available to you. So again,
making the listeners happy. I like it, sir. I like it.
It's getting close. I know I've been teasing a little bit too long, but it's one of those things where we wanted to make sure it was exactly right, and we were trying to get this tweet thing ready as well, so people can actually be more involved in the show too, so they can even comment with charts and tables that they're seeing while we're having a conversation.
Speaking of their comments and what the listeners want, I think we chose well. We chose gold. Our little quick flash poll here: 2/3 choosing gold, sir. So I guess if you went E-mini the way I liked, we would have let a lot of people down. So good for you for turning me to the right track, sir.
Yeah, no, I just wanted to mention that. I mean, the June contract I said from a quikskey standpoint, and then if you also go out and look at the December 17 contract, you'll see that the puts got a little bit better bid and the calls got a little bit better offer. So the whole idea of these reports is to sort of take a look and see what the term structures are doing, what the term structure specifics for those volatilities are doing for that. The money, obviously, but for the skew and the quick skew as well. So you can start to see, where the bias might be and match that up to the trades that are occurring. So I think as we move on in the show and as we make this quick skew number more and more available to people, and as people start seeing the charts, and I know there's a question about the quick skew, and we could talk about that at the end of the show, I think that we'll really start to see a little bit more interest, and maybe we'll get some feedback during the show so we can answer some really specific questions about that in general.
Speaking of answering some questions, sir, let's get to it and dive right into some futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody. Like the man said, it's time for your feedback. And, we like to work it in throughout the shows. You guys have been voting on what products to do. You guys have been sending in other things. So we even got the nubs featured early on. I like saying the nubs. It cracks me up. But we got all you guys. We got you featured, sprinkled throughout the show, including your own segments. You guys can't ask for any more. Let's see who we got up here next. Oh, we've got Silvan. Silvan wants to know, this is one for you, Nick. Does Quikstrike actually quantify the rent? So you could collect X rent in product Y if you sold it, etc. Also, he's got two questions. He got a doubler. He's getting two for his money. I didn't see that. I would have cut him off. Also, how do I read that quickskew graph? Not sure I'm looking at it correctly. Well, I'm not sure if you had the quickskew on the TWIFO page on CME Group. You must be referring to maybe one of the graphs we tweeted out during the show or one of the previous shows, something like that. So I guess he gets a twofer here, Nick. First off, what the heck are you talking about with the rent? Is it an actual number people can sink their teeth into? And then how do they intuit and interpret that quickskew graph?
Well, first off, if he was from Boston, instead of getting a doubler, he'd be getting a bubbler, right? I would imagine. So maybe he's from Boston asking two questions.
I'm not a Boston. I'm a Southern New England guy, so the Boston would kind of be our enemy. We're from Connecticut.
Yeah, it's a dumb pun. It's a bad effort. So in any case, so do we actually quantify the rent? I would probably answer that question no, because we put the numbers up there and to just give you an idea of what the expectation is from a movement standpoint in order to pay for owning that particular group of options. If we were to quantify it, and it's a good idea, I think, as I'm looking at the screens and starting to see other columns that we can put up there. If we quantify it, then we would probably want to look at what happens day over day in actuality from an increase in volatility as well as the theta decay. So that's something that we could probably do fairly easily and give you an idea of saying, hey, vol increased this much to offset this much decay, or vol didn't increase at all and we did get this amount of decay out of it. So we probably could do that for you, and then I think you'd see it very easily because we could chart that. And I look at it. We call it attribution here. So we see the attributes of the pricing model and see how they affect where the actual prices are going from a day-to-day basis. And the two that are the biggest ones are obviously the vol and the time. You have obviously the future and the strike, but the vol time in the future. So which would imply the future would imply the delta, right? So that's something that we could take a look at, and we could really start to look at a chart and see how much that theta is really knocking it. But the idea behind the rent is to give you a sort of a gauge to say, well, this is how much something's got to move in order for me to really benefit this. And really, the point of that is, if you get that much movement, it's a very good possibility that you're not gonna lose money by owning that option. But that's something that we're going to look at, and I will take notes and we'll take a look and see if we can do some little bit of attribution graphs for you so we can see it a little bit more clearly. As far as how you read the quickskew graph, okay, what you want to look at there is when you are looking at a chart, the darker line is going to be the call line and the lighter line is going to be the put line. And we're revamping our coloring scheme and our charting a little bit, so it'll be a little bit more clear even as we move forward. But the way to look at that is if a line is above the x-axis, that means it's trading rich to the at the money. If a line is below the x-axis, that means it's trading cheap. So the idea there is because if we look at the skew, like if you had a skew of like a risk reversal skew of say 0, it's not really telling you that the call volatility minus the put volatility is equal to 0, but it really wouldn't tell you whether those call and put volatilities were flat to the at the money, whether they were above the at the money, or whether they were below the at the money. And the same thing with the butterfly. If you had a butterfly that was 0, it's or positive or negative, it's not really telling you what the position of the call and the put are. So the whole idea behind the quickskew is to very quickly let you see whether the call or put is rich or cheap to the at the money, and then what the relationship is to each other. So if you see a gap between the call and the put, that's basically telling you how wide or how much of a distance those two are from each other. So right away you get, and also what you see is if you have, say, a call that's trading above the x-axis and a put that's below, then you can, from that chart, you can tell what the shape of that volatility curve looks like. So that means the calls are bid and the puts are offered. So you see something sort of tilted from the top right to the bottom left, and vice versa if the puts are above. And if the put and call are right next to each other from a charting standpoint, that means that you have a pretty symmetric smile. So that's the way to look at it. It's a richer cheapness, and it's not in volatility percent. Okay, it's in rich or cheap. It's just purely how much percent rich or cheap. So for instance, if at the money's trading 10% and the put is 10% cheap, that means it's trading 9%. And if the call is 20% rich, that means it's trading 12%. So it's not, and that might have been a bad example because those were actual, no, that's not. That's a perfect example, actually. So that's how you want to look at it. It's rich. It's not the actual vol numbers. It's taking the vol out of it because for that exact reason. So a 10% at the money versus 100% at the money, 2 volatility and 100% is 2%, where two volatility and 10% volatility is 20%. So it was meant to normalize it so you can really see how rich or cheap something was to the at the money. So I hope that answers your question.
Good stuff, sir. Deep dive into the inner workings of all things Quikstrike, and indeed rent. I think the rent one is interesting as well, just because I think we probably should hit on that more on the show. Put out some rent numbers, maybe put out a little rent report for the show. What's paying the rent this week? A lot of cool things I think we could do with that. And people seem to be sinking their teeth into that one. So maybe we'll run with it a little bit too, listeners. You guys seem to like it. Let's see. Let's do this easy one here first, and maybe we'll end pontificating on this more in-depth one here from Maribel. Let's do the quick one first. This is the comment or question from Tom S. He's following up on some of the questions we had recently. He says, that barrel of oil question was kind of cute. Is it worth a show about the actual delivery process? I don't know about you, Mr. Nick, but breaking down the arcane minutia of warehouses and the shipping and all the freight, that I don't know if that's really the purview of this program, which is very much localized to the options side of the space. Granted, if you take delivery, if you tend to use options for that purpose, that does come into the equation, but the lion's share of our listeners are probably not in that realm. So I don't know, unless you're really keen to do it, Mr. Nick, I'm going to have to tell Mr. Tom perhaps he should look elsewhere. Perhaps that CME Group Institute we referred to on the show a few weeks ago does a lot of education. Maybe they have a nice deep dive into all things delivery. What do you think, Mr. Nick?
I think we could probably, if we get a CME person on the hot seat, we can ask them about their specific market. We could have it the Tweedo, right? The Tweedo report, this week in delivering options.
This week delivering options. Oh no, we're extending that brand. We might break it, sir. It's going so far beyond what it was initially intended to do.
That would be Tweedo dumb, right? Tweedo D and Tweedo dumb. That would be the.
That
Tweedo
might be considered dumb if we had a Tweedo this week in delivered options reports. Yes. So you're weighing in with me on the no category, sir? No side.
I think we can maybe we can a listener question. We could do the delivery process. I don't know that I'd have enough to contribute for an entire show.
Yeah, I don't see us filling a full hour, or even a half an hour with the nuances of delivery. Not really our bag, nor do I think our listeners, except for Tom S. He clearly wants it, and the guy who wanted to know about the barrel of oil coming to his house, he wanted it, but maybe the rest not so much. So we're gonna say a polite no on that, unless we get an onslaught of mail saying, please break this down. In which case, because you asked, we'll go into that horribly arcane, minutia-filled process, but for now, we shall skip it. All right, speaking of minutia and sometimes arcane, we got an interesting one here to end it up here, Mr. Nick. It kind of came in, so I haven't had a chance to do a full dive into this article. You probably haven't as well, Nick, because it kind of came in kind of late. But this is one from Marival. He wants to know, hey, there was an interesting piece recently in Modern Trader magazine about selling break-even strangles. They were on copper, actually. Have you seen it? What are your thoughts of this technique? Is it me, or are there new techniques for selling strangles all the time that always tend to blow out? Aren't you better off selling an iron condor or an iron butterfly due to the limited risk? Well, I had a brief time to do a cursory breakdown of this article, so I'm probably I don't have time to do the full thing justice. If you want to read it for yourself, this is from last year in Modern Traders magazine. It's called Strangles and Break-Even Pricing by Paul. I think Cretien is how you pronounce that. Cretien, so you can search for that yourself, listeners, and see the full article. It's pretty in-depth charts and graphs, so I didn't have a time to really do a full deep dive of it. But essentially, he has his own nuanced way to determine the break-even for selling the strikes. That's really where the strangles, where the rubber meets the road when you're selling strangles, is how do you determine the strikes. I've seen, as the listener mentions, I've seen legions of different ways of going about this. One of the more common ways is to pretty much pick the one standard deviation, aka the Bollinger Band, to the upside and to the downside, and sell the call and sell the put on those. And that's where you draw the line. Other people have their own nuanced way of doing it. Maybe 2x Bollinger, 2x standard deviation, half, somewhere in that range, maybe on some other technical indicator. So there's a lot there. I think his personal, again, this is a breakdown of selling it on copper options. He also, I think, uses the analysis on currencies a little bit later. So it is very much futures option centric. He calls it his limited logarithmic regression model for the delta values here. And that's kind of how he uses it to pick his strikes. And there's a very in-depth explanation of what that is. I don't think we can fit it into a few minutes here on the show, but he outlines that it works pretty well for him in this copper scenario. Again, I haven't had a chance to break down the data, so maybe we'll revisit this on a future show when we've had a chance to sink our teeth into this a little bit. But I think a short answer to this question is I do kind of agree with Marival, with the listener here, that there does seem like there is a new methodology behind selling strangles all the time. That is, and of course, listeners, you're familiar with the strangle. It's just a straddle stretched out a little bit. So the risk is there. If you're selling two legs, if there's an aggressive move in either direction, you're going to be wearing it on that one. So that's why some people tend to balk, and that's why the strike selection is so important on that. And I'm kind of with you, Mr. Marival. I kind of like, if I'm going to take some sort of premium harvesting approach, which is kind of what the strangle is really, I tend to do it. I'm not an iron condor fan. I tend to like the butterfly more, simply for the fact that it's more condensed. Iron butterfly, of course, being essentially selling an at-the-money straddle, which is, as it sounds, fairly intense. You get all the theta and gamma right there on the at-the-money strike, so you're getting a lot of that. The flip side of that is any move could hurt you, so then you buy an out-of-the-money strangle against it, and that is where you mitigate yourself. And by setting it up that way, you have a fairly set-up way, a trade with a risk mitigated. You know exactly how much you can make. You know in most scenarios how much you could lose. It's a nice risk-mitigated way. You're also capturing a lot more of that theta very aggressively there, whereas out-of-the-money strangle, decay is a little bit of a different beast. They perform differently. So I think to each their own when it comes to what they like. I tend to float that way, but if you like the strangles that way, go for it. I think the condor is probably better in that sense, simply for the fact, if you're not familiar with the condor, listeners, of course, it's kind of like two strangles. If in case if you're selling an out-of-the-money strangle, and you're buying a farther out-of-the-money strangle to hedge that. So I would kind of go that way as well, just because you don't want all this naked risk on your books. Although I did have someone on one of our shows a long time ago very famously say, and I kind of subscribe to it as well, the iron condor is an iron butterfly for cowards. I do kind of like that, because you're migrating away from the at-the-money. You're a little scared to trade the at-the-money. But still, whatever floats your boat. If you are going to do strangles, I do recommend maybe you turn it into a condor if you get a little bit of that protection, because otherwise we've seen movements that are pretty aggressive in these things, and it could come back to bite you. But again, I haven't had a chance to dig too deep in this technique. Maybe we'll get back to it on a future show. Mr. Nick, you're probably like me. This question it takes a while to break it down, as you haven't had a chance to read the full article yet. But any thoughts in general on what he's asking, as well as the condor versus the butterfly versus the strangle?
Yeah, I would tend to be toward your side with a little bit of a caveat. So first off, some ideas behind that. You were mentioning the Bollinger Band and stuff like that. What I tend to look at when I'm looking for some strangles that might be of interest, I'll go out there and pull up. And this is what I'm going to describe. These are all things that you can do for free out on the CME Group website, on the Quikstrike Essentials tool in particular, or any of the other tools that are out there for free. And I'm going to mention the Essentials tool specifically because there's a trade builder in there where you can build any kind of spread that you want intra-month, and then take a look and see what the break-evens are. So you have a little bit better idea of what you're dealing with from what kind of movement you have and that kind of thing. So I like to look at, Mark mentioned the Bollinger Bands, I like to look at what the standard deviation for the given volatility on that particular contract is. So that gives me a pretty good idea of whether I'm selling a strangle within the first standard deviation or the second standard deviation, right? Because then you can start to, do some theoretical probabilities there. What's the expectation that it's going to be inside that range or outside that range? I also like to look at the OI of the strikes that I'm going to pick for the shorts, because if you can start looking at the strikes that happen to be the bounds that we talk about all the time in terms of what the trading range is right now for a particular contract, that's also another way to give yourself an advantage, because then if you're picking something that's a little bit inside the bounds, or you're picking the strikes that are on those bounds, then you sort of know if you get near those, then you might be in trouble. And then that's where my caveat will come in. You can start with a short strangle. And then if things start to, you can start with a short strangle, especially if you think volatility is high. If you get a little bit of a capitulation of the volatility, things come in a little bit, maybe then you go out there and buy a wider strangle so you can capture some of that vol that came in. Because if that one strangle came in, odds are the other is going to come in. So, standard deviation, open interest, you're going to look at how high the volatility is, right? So, the oil might be a good time to start looking at a strangle to sell, right? Because we had a pretty good pop in the volatility, and it was still a good sale even when it was low. So now it might be an opportunity here, and we've moved within the range again. So now you might be able to get a little bit juicier put and a little bit meatier call from a sales standpoint. And you got to look as well at what the movement's been, what the futures look like, and then also what part of the vol term structure you're on, right? So you don't want to go too far out, because you end up sitting on something that's not going to decay, and you want to go too close, because if you do get a rapid movement, you can get ripped pretty good on the gamma movement towards a short strike. So, I'm not. I do like that. I do like that coward's line. I think that's pretty funny. But I like a short strangle. I like a short strangle that you're watching, and then you're measuring, and then you're turning it into a short put spread and call spread, or however you want to look at it. So you go outside and manage your risk that way by taking advantage of the little break in volatility, so you can pull in some wings around it. You can even go out further if you want to even pay less for some coverage as well.
All right, everybody. The music, even though it's fun, it's sad because it's brought to the close yet another fun episode of TWIFO this week on Futures Options. Of course, if Nick has his way, we'll have Twido this week in delivery options and everything else, and he's going to extend that brand name as far as he possibly can. So before he does that, maybe we should call it quits for this week here before he gets any more delusions of grandeur. We had people asking about daily shows last time. Pretty soon we're going to have a daily show every day of the week. We're going to have a Twido. We're going to have all sorts of stuff. Nick, you're going to be working pretty hard, so watch out. But before we do that, I should mention again, our friends over there at CME Group. Check out the report, cmegroup.com/TWIFO is the easiest way to get some feedback about what we're talking about here. If you want to see for yourself, hey, what's going on in corn options right now? What's going on in copper or in the E-mini or in WTI? Whatever product you're looking at, head on over there. It's all free. Pull up the product and just look. It's fantastic. You can see the vol, you can see the most actives, open interest, the hot strikes, all that kind of cool stuff. Play around with the expirations a bit, of course, and then you too can see a little bit of the longer term stuff as well, and you get to get familiar with all these terms and these things we're talking about here on the show every week. And of course, while you're there, maybe check out their newly revamped and revitalized CME Institute, formerly the Futures Institute, now the CME Institute. So it covers not just futures, but our own purview here, options, which we like to see. So a lot of good content over there. You can check that out over there on the CME Group website as well. And Mr. Nick, you alluded to it earlier. You guys are cooking up a lot of cool stuff over there in the land of Quikstrike. What can we expect, and when perhaps can we expect some fun live tweaks to these reports going forward?
Yeah, so first of all, I want to apologize because I think I did make a promise that it would be out here today, but I ended up being out of town for 2 or 3 days, so I didn't get a chance to take a look at it before we did a build. So we're going to do that this Sunday. So next week's show, all of the links on all of the expirations will be active, so you'll be able to click and see all the things that we're talking about. Also on a lot of and probably not quite yet for the general public, but we'll do it from our side, at least for a little while. We'll be able to tweet things out a lot more. If you can't get on the tool, but you're on like an iPad or your phone, we'll be able to tweet stuff out a lot more easily during the show. So anything that we're talking about, you'll be able to see right away instead of me having to cut and then create and all that kind of thing. We're having a real nice tweet feature that's coming in very soon. So if you're game, show up next week. Those links will be live. It'll be fun. They'll be live on the free CME version, as well as the the free CME version on the tools that are available on the site. It probably won't be live within the Essentials version. It's only going to be live within the cmegroup.com/Twio. So that's what we have to look toward today. And I think we'll start to debut some of the new reports that we've been working on this month that kind of are just real big global volatility reports that take at the money, skew, quikskey, all that stuff sort of aggregated into benchmark reports and contract-specific reports. I think people are going to really like that as well.
All right, check them out over there for all things Quikstrike. And if you're playing around with the page over there, cmegroup.com/Twifo, and you're like, I want a little bit more to this, then you can always upgrade and hit up on the Quikstrike stuff. And you too can see some of the cool features Nick and I play with behind the scenes when we're doing the show here for you. And on behalf of Mr. Nick and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing to the show. And of course, for sending in such great questions. Keep them coming. And we'll see you next week for more of This Week in Futures Options.
This Week in Futures Options is brought to you by Quikstrike, options pricing and analysis software. Quikstrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. Quikstrike has you covered with market data reports ranging from open interest to the term structure of volatility. Quikstrike is the perfect addition to your trading toolkit. Learn more about Quikstrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at Quikstrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.